Everybody, we are back and we'll continue forth. Let's anybody have any questions regarding federal laws at all? I'd want to go back to one thing. Where'd it go? Oh, hold on, give me a sec. All right, one thing I want you guys to point out on the top of timeframes on TILA RESPA, the very first one, 1A, disclosure timeframes, write down the 373 rule. So timing for the LE and CD, simple enough. The LE has to go out within 3 business days of complete loan app being the aliens. It has to, a loan estimate has to be received 7 business days before consummation. All right, so how fast can you close a loan? 7 days after they get the LE. All right, and then the last 373, the closing disclosure has to be out 3 business days before consummation. So which means if you want to close in a week, rare, you would have to send your loan estimate out first day that you got the complete loan app. They would have to sign it that day because that starts that says, okay, we've got it. Then there's a 7-day before consummation, which means you then would have to get the CD out in the 4th business day, because then that's 3 days before consummation. So, if you can't send an LE out one day and then a CD out and close within a few days. So 373. LE 3 days after consummation and 7 days, 3 days after application, 3 days before consummation and closing disclosure. So I just want to point that 373, important numbers to know. Okay. You guys with me? You got talking to myself here.
I'm with you, Scott.
All right. Thanks. Nick, you there?
Yes, I am here.
Awesome. All right. Let's go. Let's get into no questions. We all feel pretty good about that.
So the 7 days is after they get after the 3 days, then you have like a seven day period, and then the
whatever day they receive and accept it, sign the LE. The fastest you could close would be 7 business days after that. So we got to send it out within 3. And then we have to wait 7 from the time they get the initial LE. So it's something that really doesn't come up in real world, but it could come up in exam world because it's one of those things. So does that make sense now?
Yep.
Okay, awesome. All right, let's go to mortgages here. Qualified mortgages, QM and non-QM. All right, so this is a relatively new thing in our industry. Pretty much everything we do fits under the QM banner, that you guys are going to do. A qualified mortgage, right? It doesn't have more than 3% points in fees. It can't be more than 30 years. It can't have a balloon payment. It can't have a prepayment penalty, right? We got that. Do you guys understand qualified mortgage, what fits into that box? Well, everything that doesn't fit in that box is a non-QM. Right. So if we were doing an interest-only loan, if we had a loan that had a balloon payment mortgage, if we had a loan that was more than 3% points in fees. So the non-QM portion of our business has actually started growing again the last couple of years. All right. So we've got loans that have higher rates and that are have an interest-only option. There's a prepayment penalty. I'm doing a loan right now. It's on investment property. And we don't use their taxes or their income. It's just based on how much the rent is compared to what their payment's going to be, called debt service coverage ratio. If your payment is $2,000 a month and your rent's $2,200 a month or $2,000 a month, basically you qualify. A lot of other aspects, appraisal, et cetera, right? So, but it has a prepayment penalty. You can buy you can buy out of it, but you can offer one. That makes it non-QM right there. There's an interest-only option. That makes it non-QM right there. All right. And then the QM has the whole ability to repay, right? Ability to repay. We've got your taxes. We've got your W-2s. We've got all of that. and this really doesn't have ability to repay other than it's an investment property and there's rent. So the non-QM, when I started doing this 10 years ago, there were really no non-QM out there to speak of. And now there actually is. So understand the difference of QM and non-QM. Most everything, I would imagine you guys do, FHA, VA, jumbo, A-paper jumbo, and conforming Fannie Freddie, all going to be QM. But a QM can't have interest only, balloon payment, excessive points and fees, more than a 30-year term. For a while, there were 40-year mortgages. All right, so that's QM, non-QM. Here's the distinguish understanding conventional and conforming. All right. Conventional means not insured or guaranteed by the government. Right. FHA loans are insured by FHA. Right. FHA doesn't make FHA loans. We make FHA loans. We package and sell them on the secondary market. But the mortgage insurance that a borrower pays goes to FHA, and they insure the lender against default. If that loan goes bad, goes into foreclosure, that's our insurance that, hey, we just made a $200,000 loan. The market went down. We only sold the loan for 100. By the time we sold the house, we sold it for 200 and we lost all this money because they didn't make payments. That's going to be paid by FHA because it's insured. So a conventional loan is not guaranteed or insured. Conventional means not government. All right. And then on the conventional side, the biggest section, what's the word I'm looking for? It's an easy word. The biggest subsection of loans that our industry does are conforming conventional loans. They're loans that are sellable and made to the guidelines set forth by Fannie Mae and Freddie Mac. Now, Fannie and Freddie are what we call GSE, government-sponsored enterprises, right? So the government has an oversight. The Federal Housing Finance Agency, FHFA, is this new agency that was created after the big mortgage collapse to oversee Fannie and Freddie. Now I got to let the dog out. She just won't let. Let's go, girl. Go. She always slips in when I open the door. So Fannie and Freddie are semi-quasi government agencies, but they don't insure or guarantee the loan, right? When we do a Fannie Freddie loan and they don't have 20% down, we get, what do we get? What do we get if somebody puts 5% down or 10% down on a loan? We get PMI. And the P stands for private mortgage insurance. So conventional loans not insured or guaranteed by the government. Conforming loans conform to Fannie and Freddie guidelines. Somewhere around 70% of all residential loans in the U.S. are made to Fannie Freddie guidelines. It's a huge amount of what we do. Right? There's a small percent that's FHA. There's a smaller percent for our veterans or active duty military. Then there's conforming Fannie Freddie. And then we've got jumbo and non-QM and all these other products that are a real small percentage of the market. So conforming conventional. So you can be, all conforming loans are conventional. All conventional loans aren't conforming. Right? I live in a high cost area, and let's take a look. You guys understand that there's how Fannie and Freddie works and the rules and the guidelines somewhat, what makes a conforming loan. The first thing that makes a conforming loan is the Fannie Mae conforming limit. So right now, loan limit 726,200. Everywhere in the United States, it's at least 726 conforming limit. Right? When I started doing loans again back in 2019. I'd been out for a while. I've been doing training, and I got my own training company, and I do a bunch of other things, but I've been out of doing loans. The conforming limit, I think, for 2020 was $510,000. It's gone up. That's what's happened to our real estate prices in the country. It's gone up to 726. But here in Colorado's gotten expensive. These are by county. We have a 787 limit here in this whole, in the middle here. This is all the Denver Metro. 787 we can go up to. Not a big hit, but you want to go big. How about LA and Orange County? How about Park, this is the most expensive real estate in the country, Jackson, Wyoming, Teton County, out here in Vail, in Beaver Creek. It's like in that area, it's $1 million for conforming loan. It's going to be a higher rate, but we can use conforming limits. So it conforms to the limits. So if I'm here in Denver and somebody wants $1 million loan, that's not going to be a conforming loan because it's too big, right? So that's what a conforming loan is. It meets the rules, including loan limits of Fannie and Freddie. They're competitors, and we sell and securitize our loan to Fannie, Freddie, and they sell them on the secondary market. That's a whole different part. I'm sure you guys have a little piece of that in your, I lost my outline here. Let me hit that safe. Okay, so that's what conforming means. Conventional, conforming. If it's government backed, and the three major government things you need to know just a little bit about that could come up are FHA, loans insured by the Federal Housing Administration, 3.5% down, down to a 620. Some lenders will do down to 580, allowable by Fannie or by FHA, down to 580 credit score, 3.5% down, higher debt ratios. It's just for a borrower that just quite isn't approvable. I bought my first house in the 80s. Under FHA loan. I was really young. We only had 3.5% down. We didn't have a long job history. We had it's just the best way for us to buy a house. So a lot of first-time buyers, but you don't have to be. Of course, VA, Veterans Administration, got to be a vet, got to all of that. And let me get back to Fannie and Freddie. So Fannie and Freddie are basically the nation's lenders. Like I said, it's around 70% last time I heard a speaker that people use conforming loans across the country. So they were created by the government as a way for banks and lenders to sell the mortgages we make, which helps us replenish our supply to have more money. And then people that invest in mortgage-backed securities and different bonds all over the world, people are invested in the debt of the United States, mortgage-backed securities, and that's where that money comes from. That is a little part of what you need to know, the origins of lending. Conventional. Limits on closing cost concessions. I talked about seller concessions earlier. So on a standard Fannie Freddie FHA deal, the seller can pay up to 6% of the sales price towards the buyer's closing cost or buy their rate down, but not down payment. Now, 6% is a huge number, but this goes back to the 70s and 80s when interest rates were 15% and 5 points, 16% and 8, and then the seller would pay the points to get the buyer the rate. Things have changed a lot. So you never, if you get 2% concessions on a deal, that in a normal market that I do, it more than covers all the buyer's closing costs. We're going to pay their upfront taxes. We're going to pay their first year insurance, all their lender fees, their title fees. Everything can be covered, but there are limits based on the guidelines. And Fannie Freddie sets those limits. Like with 5% down, it's 3% concession. But with 10% or more down, it's a 6% concession. Except for on investor loans. I got burned by that. I didn't remember that this year. It's 2%. So you don't need to know all those. Just understand concessions and limits. Fees charges on loans. We do loan level price adjustment. If you're putting down 5% and your credit score is 660, you're going to pay a little higher than if you're putting down, you have a 780 credit score because it's a riskier transaction. So they're called LLPAs, loan level price adjustments. There's a base price, and every time it's higher loan to value, less loan down, less money down, higher risk. So there's some adjustments now made in the pricing to that. They both use automated underwriting systems. Fannie's is called DU, Desktop Underwriter, and Freddie's is LP, Loan Prospector, where we take our loan application and operating system, credit report, income, assets, everything is there, and then we run it for a $350,000 loan on a $400,000 purchase, so they're putting down a little more than 10%, and it just looks at the entire risk and the type of income and everything there is, and it approves and tells us what else we're going to need to fulfill that loan. right? We're going to talk about loan origination activities. We need 2 years worth of W-2s or 2 years tax returns if you're self-employed or commission. But I can run that loan. Let's say I've got a self-employed borrower and the guy's putting down 30%. He's got an 840 credit score and his debt ratio is small and he's got a ton of money in the bank, right? He's well qualified. That loan, we could run DU and it's going to come back and ask for 1 year tax returns or 1 year's W-2s and 1 pay stub. In general, we learn we need 2 years worth of W-2s and pay stubs and a full month's worth of taxes or W-2s and a full month's worth of pay stubs in exam world. But real world says we're going to run that Fannie and Freddie and see what comes back. And Fannie's like, oh, I need 2 years tax returns. And Freddie goes, I only want 1 year tax return. I'm like, we'll go with Freddie. Pricing's the same. We'll process the loan and make sure that we do it to Freddie guidelines because they're asking for less. And that happens. I'll get a waiver of appraisal on one and not the other. Right? And during the refi boom, we used to get waivers. But you owe 300, your house is worth 800, and there's enough data out there that the underwriting engine can go, oh yeah, it's worth way more than that. We got a low loan to value, no appraisal required. But we don't know that till we run it through an operating engine and it gives us a waiver. So those are the different risk characteristics. It'll give us a different price and it asks for more or less documentation based on whether it likes the loan or loves the loan when it's approved. Non-owner occupied, which means you're buying a house that you're going to rent. You know, it's definitely a larger down payment, a larger interest rate. But there's not much else to know than that. They talk about FHA being 3.5% down. There are some Fannie Freddie conventional conforming programs for lower to moderate income that allow 3% down, but typically it's 5% down. So FHA is known as the lowest down payment, except for VA, because on VA, your down payment could be as little as what? Right? 0. So let's just hazard insurance requirements. We don't close a loan until we have a binder for insurance, right? And if they don't keep up with their insurance and we get notice that their insurance is canceled, what does the lender do? The servicer will do what we call forced place insurance. We're going to charge your account for our own insurance policy, which is pretty expensive, because if you have a lien against a property, one thing you always want to do is make sure that property is insured, right? If we have a major catastrophe, you know, I had a buddy buy a house in a big area 2 years ago that up in near Fort Collins in Boulder, that this whole neighborhood and town burned down. If you remember that, Costco, it's just these huge fire by these massive winds. We closed the loan the day before. And had we had not good insurance, we'd have been out because we just closed the loan, $400,000 mortgage against a pile of rubble, right? So insurance is always there. If it's not, it's forced place. And there are no prepayment penalties, are really not a thing in today's world. But what it means is we used to do certain types of loans, and I've got this rental income loan I'm doing that if you pay it off in the early in the first 2 years, you're going to pay a penalty of 6 months interest. Right? So they want the loan on the books for a certain amount of time to make a certain amount of money. And if you're not going to do that, so they're rare, but they are kind of making us, there are a couple of them out there when it comes to prepayment. So remember, does FHA make loans? Let's go to the next, government loans. FHA does not make loans. They don't buy loans. What do they do for us? They insure the loan. It's called MIP, Mortgage Insurance Premium, and it's paid up front. We finance it. They put 3.5% down, and it's 2.25% that's added onto that. So they finance that, and there's a monthly mortgage insurance with FHA. It's really expensive insurance, but the default rate on an FHA loan is substantially higher than the default rate on a Fannie Freddie loan. Hence, much more insurance, right? And it's insured the lender against loss in the case of foreclosure. Doesn't insure the borrower. But when people are like, I don't want to pay all that insurance, it's like, well, improve your credit, make more money, get more down payment. I don't say it that way, but the best loan is the one they can get And there are millions of people who got their first home or their only home because FHA program, and now their house is up in value. So, that's what it costs.
Yeah.
Because of risk involved. Understand FHA is the Federal Housing Administration. It was created in the 30s as the first long-term nationwide program that banks could use to get more people homes. Prior to FHA, there were just, banks made up, pay me back in 5 years, pay me interest, and in 5 years, pay me the balance. Well, home ownership rates after the creation of FHA and then Fannie Mae after that, that's when Americans in large started being able to purchase homes because there was standard financing in place and banks and lenders could make more loans because they were what? They were insured. And they weren't taking all the risk. The government said, we're going to help create a housing market and we're going to share in the risk with the bank. And now mortgage bankers like myself, I've never worked for a bank, and you guys don't work for a bank. You work for an IMB, an independent mortgage banker, which means we don't have checking and savings accounts, right? But yet we make mortgages. And we fund those mortgages off a line of credit. And then we package those loans and we sell them to the secondary market, which could be Fannie or Freddie or Chase or Flagstar, these other huge companies that are also buying loans on the secondary market. And that's called securitization, when we secure and sell. Make sense? So FHA, Federal Housing Administration, it's part of HUD. It's part of Department of Housing and Urban Development. Right? So FHA is a division of HUD. And that's what FHA does. They insure mortgages. There's multiple different types of mortgages that they allow besides their standard residential. So you can buy a house and rehabilitate it. You can buy a house and get extra money to make it energy efficient, but they all come under the guise of FHA mortgages, insured. Right? What does VA do to a loan? Do they insure the loan? Not in, sort of, but we use a different word. And I just blanked on it. God, I'm losing my mind. FHA insures. VA has a guarantee. We get a percentage that's guaranteed. FHA insures the whole mortgage. VA guarantees the top 25% basically. So if the loan goes bad, we make a $400,000 loan, they'll pay up to $100,000 in losses on that loan, 25% in general terms. All right. So let's talk about, under laws, the Homeowners Protection Act, here it is, number 9 on the federal HPA. I want to make sure we understand that. PMI Cancellation Act. So when we get private mortgage insurance on a conventional loan, it's because the borrower didn't put down what? 10%. Or 20%, sorry. God. I've been under the weather for a few days, and this cold medicine, it just makes me a little loopy. My apologies for misspeaking, right? So if you don't put 20% down, we require the borrower to pay monthly. There's a few different ways, but they pay for mortgage insurance, which insures the lender against losses if that loan goes bad, because costs a lot to foreclose. So the 20% is the magic number where you don't need mortgage insurance. But the Homeowners Protection Act says when that mortgage is paid down to 80%, they can ask for the mortgage insurance to be removed. The max says when it's paid down to 78%, the lender has to remove it, okay? And that's of the value. Let's say I paid this simple numbers. I paid $100,000 for my house and I put down 10%, right? So now I borrowed 90%. So my loan's $90,000, 90% of 100. I put down the 10% and paid my closing costs, et cetera. But down payment is just towards that $100,000 purchase, 10% down, $90,000 mortgage. I get PMI. HPA, the Homeowner Protection Act, says when that loan is paid down to an $80,000 balance, my value is 100. It's the value based on what you appraised for when you refinanced or what it appraised and purchase price was in a purchase. That's the act. When it's at 80, the borrower can request it be removed. When it gets to 78, it has to be canceled. So before this act, lenders would keep PMI on the loans forever. If the borrowers didn't refinance or ask for it to be removed, they just kept the PMI coming in, which was silly because it goes to the MI company, and there was no reason for that. They didn't need the insurance because they were below 80%. So that's where the HPA come from. Different in real world, I did loan for a client 2 years ago, and the rate's so low they don't want to refinance, but yet their value's gone up so much that they send, hey, I paid $750. My house is worth 1.1. I only owe 600. Can I get my mortgage insurance removed? Well, the HPA says it's based on the purchase price, but servicers may remove it outside of the law because of appreciation. All right. So that's not part of the exam, but you've heard that. Oh, my house went up. I'm going to get my PMI removed. It can happen. In an exam world, it's 78% of the acquisition or the appraised value when we did it. It doesn't take in current valuation, HPA. Understand how PMI can be removed, okay? All right. Oh, we stopped. That's what happened. At the break, we stopped at Patriot Act. Patriot Act, anti-terrorism. It has a lot to do with SARS, and it has to do with identification of borrowers. Before this, HPA, we get a copy of every borrower's ID. Before the Patriot Act, I never got a copy of an ID in my life. Could have never been the borrower. So main thing is we're going to ID the borrower, and we're going to have ways to verify their identity, and then different things like that. So it's anti-terrorism. And make a note that the USA Patriot Act, unless I say otherwise, it's all the acts are CFPB, except for the one I pointed out earlier, and the Patriot Act. Right next to the Patriot Act, write down FinCEN, Financial Crimes Enforcement Network. It's just who oversees that? FinCEN. Who oversees the HPA and Dodd-Frank and electronic signatures and the MAP rule and the GLB and the Bank Secrecy Act and the Fair Credit, all those are all CFPB. Unless otherwise stated, the answer is CFPB when it comes to what federal agency has authority over these regulations, okay?
Question. Yeah. You said the two that are not governed by the CFPB is the Patriot Act and which else?
The red flag rule. It's actually called the Federal Trade Commission red flag rule. I don't always see it say the Federal Trade Commission, but the FTC is an agency. So who oversees the Federal Trade red flag rules? Okay.
And then it's governed by what you said,
FinCEN, Financial, FIN, Crimes Enforcement Network. We call it FinCEN, Financial Crime Enforcement Network is who oversees Patriot FinCEN. Okay.
Thank you.
Yeah. CFPB. And you guys, I'm sure you guys got that whole CFPB and Consumer Financial Protection Bureau. They were created out of the Dodd-Frank Act after the whole mortgage market. So before that, we like HUD all of these regulations were overseen by a bunch of different entities in the mortgage world, and none of them really focused on it. There was really not a lot of oversight. I'm not saying we had our way with anything. There were rules, and we would get HUD audits and a Freddie Mac audit, and I've been through all that before as a VP of a company, and it was intense. But as far as every day, we didn't have a CFPB who made up new rules and enforced all these rules. So the main thing when it comes to enforcement, CFPB, unless otherwise noted, okay? So QM, non-QM, government. So FHA guarantees loans, VA insures them.
Is it the other way around?
FHA insures the mortgage and VA gives us a guarantee.
Okay.
What does a veteran pay on top of their loan that goes to VA to help them fund the guarantee? What does a veteran pay on top of his loan amount? It's a funding fee. Okay. So FHA has MIP. MIP's on FHA. MIP doesn't go away. What do we get on conventional loans? PMI, because they're private mortgage insurance. So they all serve the same purpose, but it's kind of interesting. You want to delineate the difference. FHA has MIP. Now, the only time MIP can go away is if a borrower has when they start their loan, they have 90% or better loan to value. They're putting 10% down, or we're refinancing and we're lending them less than 90% or less than their appraisal. When they're at 90%, FHA MIP is 11 years. Other than that, it's for the life of the loan. It's definitely something you want to recall. So when can FHA mortgage insurance come off? If we've got 90% LTV or less. You guys both understand LTV, right? Loan to value.
Yeah.
Yeah. All right. So when the FHA, if there are times that a borrower puts down 10% or more on an FHA because their credit score is low, their debt ratio is high, whatever. It just is their only way we can get the loan approved. If that's the case, their mortgage insurance will, if they don't refinance to a conventional loan, that's something you can always do, their mortgage insurance won't come off till 11 years. Everyone else without 10% or more down, the FHA mortgage insurance at this time is forever. Where the PMI, we've got the rule that says, hey, once you pay it down to 80%, you can ask for it to be removed. When it gets to 78, you lenders have to remove it. Okay, so it's removable. And then, and VA is a funding fee. And they always pay a funding fee unless they're a disabled veteran. If you have a certain amount of disability, they waive the funding fee. Or it's a surviving spouse. You know, my spouse was killed in a helicopter crash on military duty. I'm a surviving spouse. I get to use my deceased spouse's eligibility, and they'll waive the funding fee. So it's a one-time fee that we usually just finance on top of the loan amount, and there's no monthly mortgage insurance with a VA loan, but it's called a funding fee, and then they give us a guarantee. PMI mortgage insurance, MIP mortgage insurance premium, PMI private mortgage insurance. So when you have acronyms, if you can say what those acronyms stand for, it really helps you find that right answer. Does that make sense?
Yeah.
Yeah, we'll talk about testing before we're done. As far as some of the tips I find, I'm one of those guys that am a good test taker, right? But I've been doing this long enough and have enough feedback from people and mistakes they make to help you understand what we want to do to make sure we get through that with the best chance. Okay, so conventional, government, funding fee, mortgage insurance, residual. So mortgage and payment scenarios. What's the minimum down on FHA loan?
3.5. Yeah.
That's something that just, I never don't see that when I'm looking at different exams. And guys, there's going to be some quizzes and in the exam in the information that Michael sent you guys today. But if you Google flashcards and practice tests on YouTube, dude, there are so many tools out there to help look for things. And if you guys keep this right here where this outline is, and then like I showed you earlier at the bottom, there are all these links to the FTC. FTC also oversees the do not call list, by the way. We don't really go into that, but the do not call list, you guys remember that from your 20-hour? Federal Trade Commission, FTC is that one too. FTC on the is DNC, do not call. Okay. I gotta make sure. All right. So I just want to touch base on the, so what I find, I get a lot of feedback over the years from all the students that I've done the 20-hour test for. Michael and I used to work together for years at another company. I haven't been doing as much as that lately, but I still really enjoy it. But the two biggest challenges I hear from people's practice tests and all of that are federal laws and the next section, not general mortgage knowledge is what we're doing here, but the loan origination activities. Okay, so I'm going to finish up general mortgage knowledge here. a little bit, and then we're going to spend the rest of our time talking about loan origination activities, and then a little bit about the test and the things I want you to have in your mind and the mindset for that exam that's coming up next week for Nick. Do you have your test date set yet? You told me your name. It just says AJ, so I forgot. I'm sorry.
Ashura. And yes, I do for next Tuesday.
Oh, good. All right, you guys, good timing. Let's get this class and then spend a few hours a day, and then the night before, get a good night's sleep and do it. All right. All right. FHA residual income qualification test. There's only one loan program that uses a residual. Now, you guys understand DTI, debt to income ratio, right? We're going to go into it, but you know that if I've got my mortgage payment, PITI, principal, interest, taxes, and insurance, HOA, if there is one, mortgage insurance, if there is all of that housing expense, plus my bills divided by my income is my back debt ratio. Residual is a test that VA's always used. All right, so there's a chart that says if I haven't done a VA loan in a year, so I don't remember the chart. Let's say I'm married and I have 3 kids. Then you're going to go residual for 5, a family of 5, and it's going to be X. So what that means is we're going to take your income minus all your debt, and that's the amount of money you have to live on. So there's times when your debt ratio may be high, but your residual is more than enough to meet the guideline of what is required. So I've seen and heard, because I travel the country and do my CE, my continuing education, you guys have to do next year. But when did you take the 20-hour? Just recently?
Yeah, last week.
Okay, so you guys understand you don't have to take continuing education this year because you took your PE in the year in which you're going to get your license. If you'd have taken that class in December and passed and got your license this year, you would have to take CE this year. So there's a few things we'll touch on the state test, on the state component for that. But I hear, VA, we get deals approved with 60 debt ratios because they have plenty of what? Residual income. So as you make a lot of money, maybe your debt ratio is 50%, but 50% of 20,000 a month still leaves you 10,000 a month, which is way beyond the residual required for a family of 2 or single person or whatever it is. So it's a second thing that VA uses, and sometimes it's very helpful. But back in my younger days in California, there was a couple loans I did that were really low end, and their debt ratio was okay, but they had a bunch of kids and the residual was not enough. It's like, yeah, your DTI is 45, but man, you got you only make 2,000 a month and you don't have enough money to support your family. Yeah, that's back when loan limits were much lower. So that's what residual is, right? If I make 10,000 a month and my PI and my debt ratio is 50, which is 5,000 a month for all my debt, I have a $5,000 a month residual income, which maybe on a VA loan outweighs the fact that my debt ratio is 50. Well, they still have plenty of money to live on in theory. That's what residual is. Okay. Are you guys, how do you two feel on your math skills? Everything's percentages. There's only a couple things that we need to know math-wise for this. How do you feel? And math is one of those things that, I know some brilliant people that just don't like math. And I know some people that aren't very smart that are really good at math. So it's not you know what I'm saying? Do you guys understand the few different scenarios of math that you need to do?
Yes.
Yes.
Yeah. Okay. I always like asking that because certain people, I had a loan officer training school I did in Florida years ago, and some people, I just want to make sure that we don't need to spend time on LTV. Your loan's 350, the house is worth 600, 350 divided by 600, right? Little number by big number. And debt ratios are the same thing, percentages, right? You guys are good. All right.
Yep.
Did you guys have an income section where they show you that if you're paid twice a month versus every 2 weeks versus hourly, how you calculate income?
I believe.
I don't think so, actually.
All right. So you could be asked to calculate an income. So I just want to give you a couple scenarios here to understand. Because there's difference. So if I get paid, I got a salary and I get paid on the 15th and the last day of the month, right? You take your pay stub. Oh, you get paid $5,000 twice a month. How much is my income? 10 grand, right? Everything we do is monthly, monthly payment, monthly income, monthly debt ratio, monthly, correct? So if you're asked to do income, and he says, the guy gets paid $3,000 twice a month. All right, $6,000. If I get paid $3,000 a month, but I get paid every 2 weeks, it's not twice. It's times 26, right? 52 weeks. You get paid every 2 weeks. So you're getting paid 26 times a year. So if Jane makes $1,800 or $6,800 and she gets paid every 2 weeks, you would do times 26 divided by 12. That's her income. Bi-monthly and bi-weekly are not the same, slightly different. Okay.
Got it.
And that's hourly. And then if we are going to get bonus or overtime income, how many years do I need to have established that I've gotten that?
2 years. Yep.
2 years. Anything outside of the base? Oh, I just got this new job and my bonuses are going to be huge. Yeah. Bonuses, unless it's guaranteed, I need a 2-year history and we're going to average. Same with overtime. Dude, we got this new contract at work and it's happened to me in the past. Oh, we got a new contract, dude. I'm going to be getting a ton of overtime. We just started getting a ton of overtime. Well, how much did you get last year? Oh, I made 5,000 in OT last year, but I'm going to make 40 this year. Guess what? If you don't have a 2-year history, we don't count it when it comes to ancillary income. Make sense? Yeah, I got a huge bonus this year. Well, what'd you get last year? Same job. Well, we didn't get one last year. Nope. No 2-year history. And if there is a 2-year history, we average. Same with overtime. Overtime and bonus. Okay. There's just a couple things I want to make sure you make some notes on the math section. I like to ask about the math and then understand that. And another one that comes up is calculating LTV and CLTV. You guys grasp CLTV, combined loan to value?
Yes.
Okay. Did they teach you if you had a HELOC? If I said that I have a house worth 100, I owe $50,000 on my first mortgage. I owe $20,000 on a HELOC, but my line of credit is for $30,000. So my LTV 50 of 100 is 50. My CLTV 50 plus what I owe on the HELOC 20, that's 70. So my CLTV is 70. But if they ask you for a high or a HELOC LTV, it's 50 plus the amount of the line. You owe 20, but you could owe 30 by the end of the day if you wanted to. So then if it asks for 3 LTVs, the first, what you owe on the first and second, and then the last one, the HLTV, would be the 50 plus the line of the not what you owe on the line, but how big is the line? My line's 30. I owe 50. So my HLTV, my HELOC LTV would be 80%. You get it?
Yep.
Okay.
Yep.
So on a HELOC, you could owe 40, but your line could be for 100. In real world, we're going to use the 100. If you're keeping that HELOC, we're going to use that 100. Okay. Because you could borrow it tomorrow. You could borrow that by the end of the day. So it's a weird thing we don't use, but in all my exam prep and the classes I've taught and the stuff I find online, I see that question a lot. So I'd like to make sure you understand it. Okay. All right. Makes sense? So jumbo loan. Is a jumbo loan a conforming loan?
No.
Is a jumbo loan a conventional loan?
Yes.
Very good. Correct. Right? Jumbo means it's what? Bigger than the conforming limit. All conforming loans are conventional. All conventional loans aren't conforming because conventional just means not government. So a jumbo loan, great example of a conventional loan that we call non-conforming. That is a norm. Hey, what's your non-conforming product like? Oh, we got this A-paper jumbo. It's great. Blah, 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 blah. So jumbo conventional, just too big. Too big. All right. Non-conforming. Non-traditional. You guys get my favorite definition in all of mortgage is a traditional loan. A non-traditional mortgage is defined by the CFPB as anything other than a 30-year fixed. To me, it's a 15-year fixed, pretty traditional, but nope. What's the non-traditional loan? Anything that's not 30-year fixed, non-traditional. So when you guys we talked about the escrow account earlier. Escrow, you're paying your taxes and insurance, and we collect 1/12 of your annual taxes and your annual insurance with your payment every month. But we also, depending on the month we close, take a big chunk up front to put into that escrow account. So escrow accounts typically are required on FHA and VA government loans, required. You don't have a choice. On a conforming loan, if you have PMI, typically they'll want you to have an escrow. But if you put down 20% or you have more than 20% equity on any loan that's not government, you have the ability not to have an escrow account. So they're not mandatory on all loans, but the rules apply the same if you do have them. You get an initial escrow account statement after closing within 30 days. And every year you get an annual escrow account showing how much money went into your escrows. We paid your insurance. We paid your 2 halves of taxes. This is your balance. And if it's more than a $50 cushion, or more than 50 more than it needs to be, we're allowed to have a 2-month cushion in there. So if my taxes, one thing that you have to learn to tell your clients, your escrow account's always every year it's going to go up or down. Pretty much up because taxes and insurance go up. But sometimes we overfund. We got too much money, so we're going to reduce it. It can happen. Escrows. Higher price loan, high cost loan. Those are the only ones in exam world that have a rule that you have to escrow. Because they're conventional loans. All conventional loans don't require escrows. All government loans do. All right. Subprime lending, just read through that. It's really, none of this stuff exists anymore. So you have to remember all these new rules and this legislation for CFPB and the qualified mortgage rule and pre-licensing education and even having a license, that all came out of the subprime market collapse. So there's a ton of stuff that they've taken a lot out, but they still have a lot of stuff in there that doesn't apply to today's world because this is why we got here. For all these subprime, there's stated income. There's no stated income loan out there. All right. But we understand DTI. We do. Remember, if there's a question about debt to income ratio, the only thing that goes at housing, PI. Now you won't have to calculate the principal and interest because you don't have the financial calculator or a loan operating system. But if they give you homeowners insurance, annual taxes, monthly or annual HOA, those all monthly have to go into your housing expense. And then on your debt ratio, your back end or bottom debt ratio, it's all credit debt, right? Not utilities, not self-reported. It's only things that would be on a credit report that are actually liable for contractually for credit that you borrowed. All right, so this is a lot of stuff, non-QM, anything not qualified. The definition of a non-qualified mortgage is a loan that does not meet the definition of a qualified mortgage. It's interest only, it has a balloon, it has a 40-year term, etc. All right, let's go one more break and then we'll finish up. Sweet, all right? Also, Q&A at any time, since there's just a couple of us, you guys have been a great job asking questions, but any kind of clarification or anything that in this last hour that you feel that you want to touch on, please just let me know. All right. So let's go back here and finish up where we are with the move into just mortgage loan products. Just real quick on a couple of things here. A purchase money second. So that's something that's rare, but in today's world, there's a thing called assumability, right? You guys know that FHA loans and VA loans are both assumable. And this is something that came up in a lot of my classes I was doing last year, with loan officers all over the country. We have breakouts and we talk about all the different things going on in our marketplace inside of our CE class. It's all within the realms. But one thing that we're talking about is there are loans out there that are assumable now that makes sense for a borrower. If I bought my house 2 years ago with a 3.5% FHA loan with mortgage insurance premium every month, is that still a much better loan that I could get today at 6.5%, let's say? It is. So in that case, let's say that they bought a house a couple of years ago, and I'm going to be able to assume the first. I have to apply, I have to qualify, both VA and FHA. I can assume that loan, and there's 28 years left at 3.5%. Well, let's say they owe $300,000 on that loan, and they made a lot of money. They bought, in many markets in the country, they bought it a couple of years ago. They've got a lot of equity. So they owe $300,000. I'm paying $500,000, and I only have $100,000 down. So that's 20% down. So I might have to get a second mortgage to bridge that gap between my first and my down payment. If I owe $350,000 and I'm getting a $400,000 loan because I've got 20% down, I need to get a $50,000 second. And because it's being used to purchase a home, purchase money second, right? You could get a HELOC that would, for $50,000, max it out. Now you have an assumable first, you've got that second, and then you've got your down payment. So that is a situation where we'd use a purchase money second, right? Fixed rate, I don't think there's anything to say on that. Adjustable. Adjustables would be more popular if the rates were lower. There used to be a much bigger spread between a fixed rate and an adjustable rate. I did just look at about a $700,000 loan this weekend for a friend of mine who's buying a condo up in the mountains. And his loan is going to be about $700,000. And we started talking about an ARM because it's a second home. The guy does real well. And he's like, yeah, kids getting, I don't know. I don't even know how long we may not even have this house 5 or 7, but it's a great deal now. And we want it for now. So we started looking at a 7-year ARM, right? What does a 7-year ARM mean? It's a hybrid, right? It's fixed for 7. And then it turns into now a 6-month ARM. After 7 years, it's fixed. And then every 6 months, the loan adjusts. So we call that a 7/6 ARM. Fixed for 7, adjustable every 6 months thereafter. Right? You might have learned in your 20-hour class forever, it would have been a 7/1 ARM, fixed for 7. And then every 1 year after that for the next 23, it's a 30-year loan, but then it's adjustable every year after that. Well, now they're mostly 6 months ARM. So either way, it's a hybrid, right? But what comes on an ARM is caps, right? There are limits of how much your ARM can go up or down. So there's a periodic cap. Every 6 months, it can only move more plus or minus 1%. And a lifetime cap. Let's say the caps are 1 and 5. So at the end of 7, every month, once a loan becomes an ARM, every 6 months, it can't go up more than 1%. It could go down up to 1%. If rates go down, your ARM can go down. If rates go up, your ARM's going to go up, but it's got a cap or a limit. And then it's got a life cap. So if he's doing a 6% 7-year ARM with a 2, 1, 6 cap. Well, the first 2 says at the end of 7 years, it can move up to 2%. The 1 says every adjustment period, every 6 months after that, it can only move 1%. And the 5 says your rate was 6. Your max, it's never going to be more than 11. Well, when people take ARMs, and I've done a ton of them back in 6, 7, 8, 9, 10% markets, it's like, well, we'll refinance out of that when we can. It's not as risky as it sounds. And there's a lot of people that don't mind taking that risk. So we're seeing more ARM products out there than we have in years because interest rates and home prices are making homes less affordable. The guy's looking at a $700,000 loan, and it's going to save him because it's an investment property, maybe 0.5%. Well, the guy's very wealthy, and to him, it's worth the risk down the road to save that amount of money right now. So there's caps. And when it's time for it to move, there's index and margin. Like the index, this new index that they're using, index is a way that you value what it's tied to. So let's call a HELOC is tied to prime, right? Home equity line of credit. It's prime plus 1. Well, if prime's 4% and that's your index. If prime goes up, your rate goes up. If prime goes down, your rate goes down, because index is what it's based on. What prime does is, and what LIBOR, which doesn't exist anymore, but you still see it out there all the time as examples. LIBOR used to be the main index that all loans were tied to. So you've got an index called prime or LIBOR. I forget the new one. I can't ever remember it. It's just a new one they've made up, kind of. And what happens if rates go up or down based on that index, right? But you don't just get the index. They actually add something to that, and that's called the margin, right? So if prime's 4 and my margin's 2.5, prime moves to 4, the margin add 2.5. What's my rate going to be? 6.5. Unless my cap that we just talked about won't allow it to go that high. Oh, but your cap's 5, so it can only move to 5. But as soon as it can get to 6.5, it might. But what might happen during now and then? Rates could come down, so maybe it doesn't go up as much. So those are the few things that are in your text, and make sure you understand just the basics of how caps and index and margin work. Make sense? All right. If it doesn't, just say something. A balloon mortgage, it's just something that used to be done a lot. They would give you a longer payment term with a 30/5. That's a 30-year mortgage payment. At the end of 5 years, you got to pay me off. And what was expected in balloons in modern world was you're going to refinance or sell your house before then. Right. But sometimes, there are loans that there used to be a Fannie Freddie balloon loan back in the early 90s. It had a refinance provision. It would reset. But if you filed bankruptcy, if you had a second mortgage, if you were late on your payment, or if you had moved out of the house, then it didn't reset in 5 or 7 years. It was due, which makes it technically a balloon. Oh, you no longer live in that house? Well, it was a 35, but with a 5 that would readjust at the end of 5 years to the new current fixed market. It was only on the market for a little time because people didn't understand it, or they forgot. Yeah, but what do you mean it's due and paid? Well, you moved out of the house. It's 5 years up. It's now a balloon. You got to pay it off, etc. Balloon. Reverse. Just there's a little section in your text about reverse, right? You got to be 62. At least one of the borrowers has to be 62. You got to live in the house. I actually did my first one last year. Got to live in the house. And for a lot of seniors who have a lot of home equity, but they never really put money into retirement, or now their retirement accounts are worth a lot less because of what happened in the market. And now they're looking for other ways to get income or to not have a mortgage payment. Reverse mortgages have blown up. Now seniors are sitting on a massive amount of equity because of housing values have gone up in the last 5 years tremendously. And now that's one of the main assets they have. And they call it retiring in place. They don't have to, man, if we, like the guy here in Denver, I did one from, he's a referral of somebody I'm in a group with. And never really made any money. His Social Security is $1,200 a month. He never reported any money, but he's not good with money. He doesn't have hardly any savings, didn't have a retirement account, but he bought this house like 9 years ago. I don't know. He owed like $200,000 on it. It's worth $800,000. So we wanted to refi, but we couldn't refi because there's no proof of income. He had a decent interest rate. So what we did is put a reverse mortgage on there, paid off the current mortgage, and now he has no mortgage payment, right? So he lives in his home, and all you have to do is pay the taxes and insurance, right? Make sure you understand that, taxes and insurance, but with no mortgage payment. So now he's in a way better, because if he sold the house, where's he going to go? Go pay $2,000 a month rent in Denver for a one bed? He didn't want to do that. He's got this house, way better than renting. So now he has no rent and he can afford to live there. reverse, that we pay them, and then every month, what do? We charge the interest that he's not paying, and they add the mortgage insurance, because almost all reverse mortgages are are called HECM, home equity conversion mortgages, and that's an FHA product, which means it has what? If it's FHA, does it have mortgage insurance? That's what FHA does, insurers loan. It's an FHA product.
So the 200,000, did the loan pay that off, and now he pays?
Yeah. So when we refinanced, we did enough to pay off his mortgage completely. So the mortgage that he had is gone.
But he still has the payment to pay back the 200 that they paid the mortgage off with.
Well, he had a $800,000 house and he owed $200,000 mortgage. We did a $250,000 reverse mortgage. So we paid off because it has to be in first position. So the new mortgage has got to be the only mortgage. So we're going to get right down here. It talks about junior liens, subordinate liens. Let's talk about lien position. What makes a first mortgage the first mortgage and a second mortgage the second mortgage? The date it's filed. The first was the first one there. Now I go get a HELOC, it's second. If I go into foreclosure, who do you think's get paid first? The first mortgage or the second mortgage? Right? It's position. So what makes a first to first is the date, and that's why lien position matters. So when we close a loan, we get title insurance, the lender does. And that's it. The title company checks everything and says, there are no liens or judgments or anything else here that could ever be in front of you guys except for taxes, because taxes are always first. So we want to make sure there's nothing outstanding to make sure if we're in a first mortgage, we are the first one in line when we foreclose. So that's why we get title insurance, to ensure that there's not a lien or a lawsuit or some private mortgage that was recorded that never got paid off or whatever. So that's what lien position is. So to get a reverse mortgage, it's always first. So if you have a mortgage, we're going to have to get enough to pay it off and reconvey. We're getting down here to terms used in the mortgage industry. So when we pay a mortgage off, the title company then reconveys. They take the lien off the property and put ours on there. So now we're first. That's how refinance works. We're paying off the first with a new first. Well, how do you do that? Well, when you pay off the reconvey, the deed comes away. Now we're the new first mortgage. So he doesn't have a mortgage to pay because his mortgage is a reverse, requires no payment. So now he has no mortgage payment, and he got some cash back because he had a lot of equity, and he got some money to him. And every year he can tap into a little more of that money if he wants. But we add interest and mortgage insurance every month till he can't live there or he dies. And then if they sell the house and he had a family, this guy doesn't have kids or anything, then the family can sell the house and make the money. But if you don't have any equity, you just let the house go and it goes back to FHA, and it's not even considered a foreclosure. It's for seniors. And they're really popular, getting really popular. They're a little expensive, but they're way cheaper than the people not having a place to live or going and renting, typically. All right. Let's look at this interest only. I want you to understand how to calculate mortgage interest. Did you guys do that? Right?
Yeah.
Yep. Okay. Because if you have to figure something out per diem, per day interest, right? $100,000 loan at 6%, that's $6,000 a year divided by 12, that's $500 a month. Divided by 30 is how much a day? Actually, if you want the daily, just divide the annual interest by 365. All right. So those are a junior lien is like if we have a house right here I'm sitting in, got a first mortgage. We went and got a HELOC in case we wanted to do something. And the HELOC was after the first, which makes it a second. Other terms you can hear for that is the senior lien, the one that's been there longer, and you got a junior lien. And the reason lien position matters is when it comes to foreclosure, which is why we have liens on houses. If we don't pay, the first gets paid first when the house is sold and foreclosed on. And if there's any left over, the second can get paid, but there's no guarantee. First is always going to get paid before a second. So that's why we get title insurance, and that's why a second mortgage is more expensive and more risky than a first mortgage. Make sense? All right. reverse mortgage. And the reasons people can have to leave their reverse mortgage is they didn't pay their taxes. They don't keep it insured. They don't maintain the property. They move out for more than 6 months. You can leave a certain amount of time for medical purposes, et cetera. So you can't say you can never make another payment or you live there free because you have to maintain. We have to show that he had enough income to maintain his home, taxes and insurance, and a little bit of money left to eat. So there is a slight income requirement now to make sure that they can actually continue to afford what they have to afford to live there, or otherwise they can't get a reverse mortgage. So junior lien, subordinate lien. Subordinate is not the first. It's the junior. That's the same thing, right? And then if the guy got sued and he had a first mortgage and a second mortgage and he got sued and he owes me money and I want to file a lien against his property, what would I be? I'd be the third mortgage. I'd get paid third. I'd be subordinate to the subordinate. So primary, subordinate, liens. Understand? All right. Higher price mortgage table funding. So company I work with, we're called a correspondent lender, which is different than a broker in the fact that we table fund. All right. So when I send a loan to a couple of investors that we use where we're approved as a correspondent, we close the loan in our name. Right. We're using a big wholesaler. Let's call it Rocket Mortgage, right? They do wholesale. I brokered the loan to Rocket, but we're a correspondent with Rocket. So all the documents say sustained mortgage. And we have a line of credit with a bank. And we fund the loan off of my line in my name, knowing full well the loan's been underwritten. And as soon as I get all the documents back, I'm going to sell that loan and get paid from Quicken and pay off my line of credit. So am I the lender? No. But at closing, does it look like I'm the lender because we're funding it in our name? That's what a table funding is, a table funding correspondent. It gives us a little more, anyways, not part of the class, but table funding is. Make sense? Yeah, it's interesting. All right. Yield spread. So read through these terms. There are amazing glossaries out there. If you just a lender's term glossary, there's a glossary in the exam prep thing that we sent you, I believe. If you see any kind of go find yourself a mortgage glossary if you need it, just to know what all of these terms mean. All right, loan origination activities. Make sure you understand. I want you to go through. Let me find it here. Here it is. All right. This is also single family. This is from Fannie Mae. This is the loan app. Familiar side. I would say that you guys should complete a loan app on yourself. Have you done a loan app like in a training class or something there besides the 20-hour class?
No.
Okay. I would say complete a loan app on yourself so you're more familiar with the loan application, just like I want you to be familiar with the LE and the CD. What do we call the loan app? What's the term that we use? It's the form number that we all use in the industry. 1003. Not the 1003, not the 1003, 1003. So if you see something about a 1003, what is it? Loan application. Also known as the URLA, Uniform Residential Loan Application. We use a 1003 for every freaking kind of. It might be a Fannie Mae form, jumbo loan, Freddie Mac, FHA, VA, USDA. It doesn't matter. We're doing a loan app 1003. That's what our industry's always used. It's changed in the last 10 years for the first time basically ever, but that's what the 1003 is. So there it is at singlefamily.fanniemae.com. Okay, 1003. So understand what it's asked. I would go through that. Oh, shoot. I got out of my guide. No problem. Excuse me. All right. So way down here. Terms. Loan origination activities, 1003. Credit report discrepancies. Gift donors. It doesn't matter. Those are good. Application accuracy. So let's talk about loan origination activities. That's part of the SAFE Act, right? Secure and Fair Enforcement Licensing Act. Why are we in this class? Because of the SAFE Act. Why do we have to get a mortgage license in any state we want to do business? Because of the SAFE Act. All right. So that's part of what drives all of these things. A couple things I want you guys to know. It's kind of interesting about the SAFE Act. You just took how many hours was that pre-licensing course you took? By regulation, it's a 20-hour class. All right. 3 hours of federal law, 3 hours. Good Lord, I just did it. I do CE every year. I tell you what, I'm sorry. I'm really 3, 2, and 2. 3 hours of federal law, 3 hours, 2 hours of ethics, and 3 hours.
The regulations?
Yeah. Well, federal law is regulations. Just, God, I know I wrote it down. I've done this thing 1,000 times. I think the senility is kicking in. All right. I'm going to Google that here in just a second because it's super simple. But know that the 20 hours is required. How many hours of CE do you need to take every year after you get licensed? And the answer is 8. All right. Know those questions that are about licensing. Even though you're getting licensed, know the questions under the SAFE Act and under the UST. So in your class, the last part, you guys, was UST, Uniform State Test Component. Continuing education requirements. That's where you're going to find those things. And all you want to do is just review that information. Safe Mortgage Licensing Act. So here's the SAFE Act and every subsection of that. Loan origination activities is what I want to talk about. If you get a license, you are taking a loan application, you are offering or negotiating terms of an application. And for all these things, you can get, so there's taking an application, which is quite lengthy, but you get it. And then you offer or negotiate terms of a loan. And it's all done for what? Money, for compensation or gain. That's the definition of a loan originator, right? An originator compensation rule basically says you can get paid salary, you can get paid hourly, but if you get paid commission, which is basically what our industry is, you know, the more loans you do, the more juice you get. You can't be paid on any loan different than any other loan, right? We used to have compensation based on profitability. So we could charge more, and then people would steer borrowers into a higher price, a higher profitable loan because they would make more, or the company. I'm not saying we all did that, but it got really bad. So many people got in the industry when it was no doc and subprime and all that crap. It was horrible for our industry. I hated it at that point. We did great during that time, but our industry, and now we have all these rules to do with that. So understand that. Loan origination activity requires a license, and what's not a loan originator activity? Processor, underwriter, those folks, they do what they call support or clerical services, and they don't need a license because they're not negotiating. Like if you have a processor, your processor can't take the loan, and they can't advise people on loan terms, and they can't get to help quote interest rates and cost. Those are loan origination activities, which are covered under the SAFE Act, loan origination activities. Also, the loan originator compensation rule says I can't get paid more for steering or directing a borrower into one loan than another. What I can, the only thing that changes how much I make on a loan is the size of the loan. Like we charge the same percentage on every loan, and I pay me the same percentage. Whether it's a jumbo loan or an FHA loan or a conventional loan, I make the same percentage. I can't control loan amount. I can control if I can steer someone into a more profitable loan. Okay, so those are some of the main things we want to take away on that. Let me get back to this page. So change, and the NMLS on the SAFE Acts. Well, let me go back to loan origination activities. I want to make sure we got 30 minutes. So ethics is pretty much a review of federal law. Just read through the ethics, and anything you don't understand, it's easy to find with all these links and all the information out there. And we talked about, I did about financial calculations. We talked about how to figure a payment. If you have to figure a payment, I'm not going to repeat myself. I did that. They're going to give you the P&I. Don't worry about that. Down payment, 10%, CLTV, LTV, loan to value calculation scenarios, debt to income. It's going to tell you what math you need here. And we already talked about that. And if I'm paying a discount point, what am I discounting? If you pay a point, what gets paid? What's better? What gets better? The interest rate. Okay. Discount points is upfront interest you pay to get a lower rate over the length of the loan. So if I pay a point, $3,000 on a $300,000 loan, and I get a 0.5% better rate, my payment's going to be lower, and it's going to take a few years for me to get my $3,000 back. But over time, I'm going to save a lot of money. So it doesn't really make sense, but that's what a discount point is. You're discounting the interest rate by paying a little fee up front. And unless you're going to stay in that house a long time, probably not a good idea. What was that, Nick?
It's 1% of the sales price, right?
Anything called a point is a percent. Now, it might be 0.374% to get down to the next eighth. So it's a fraction of a point or a point, but we use the term discount point. It could be a half, it could be 2, it could be any number, but 1 point is 1% of the loan amount. We don't ever use sales price for our percentages for an origination fee or discount loan amount, correct?
Okay.
All right. So ethics. Under ECOA, one of the things that was outlined for ECOA, we didn't touch on earlier today because it's here, is redlining. It's kind of funny. FHA invented redlining. When FHA was created in 1937, during the middle of the Great Depression, trying to help home ownership, and banks make more home loans, and banks were like, we made home loans and the market collapsed and we lost all our money and the banks are failing. So FHA started insuring loans. But guess what they did? They didn't lend to everybody in all areas. It was 1937. There was no Fair Housing Act or ECOA, Equal Credit Opportunity Act. They actually invented redlining, and redlining means we draw red lines on the map and say we don't lend to people live here because these kind of people live here. The values of these houses aren't the same, blah, 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 right? So redlining is way illegal, but it was invented by FHA, and then banks continued it for many years. And there are still places that I'm sure redline. They don't want to lend in certain markets. It's illegal, but that's what redlining made. Truly because they drew red lines around certain areas where they didn't want to lend. All right, we talked RESPA. Remember, no kickbacks, nothing for a referral, but a thank you and a high five. And in dying, loyalty and friendship. But if it's tickets, if it's a gift card, if it's cash, if it's a trip, that's my drink. I took it. That's part of the kickback, and it's for the expectation or the thank you for a referral. So you can't buy referrals and you can't pay for referrals. Application red flags, occupancy fraud. That's a big one, especially now. The cost to get a second home or a investment property has gone substantially up. So there's a lot of people, and it's happened my entire career. You hear about people trying to get a house and say they're going to live in it when in fact they're not. And that's occupancy fraud, right? Oh, no, we're going to rent out. Oh, so you're going to rent out the house down here that's worth $900,000 and you're going to move across town into this 2-bedroom, 1-bath, $600,000 house. Are you? And we can't call them liars, but we can ask for lots of documentation. In fact, yeah, sometimes underwriter there's time we just won't do a loan because of occupancy fraud, because people try to do that. Scenarios, advertising, those are all in RESPA and TILA. ethics is pretty simple. Just, I know you guys have a section, you went through it. Just review that. There's like the laws and the loan origination activities. Make sure you fully understand that. But when it comes to the ethics, but let's go to the last part, the state, uniform state component. Okay. This whole SAFE Act was written to impose every state to create a state agency that oversees mortgage licensing. You guys set up an NMLS account. That's where you got your unique identifier, which goes on everything. If you're putting something out in an email, on social media, on a fence post, it doesn't matter. If it has your name and it implies that you do loans and you want to do loans, what do you put on there? My number, 1899020, right? It's a number that will be tracked forever with you in the mortgage business. It's called your unique identifier, your UI, right? So you already got your UI. You've already gone to the NMLS on your account to get your test date. What state are you guys going to get licensed in?
Michigan.
Michigan.
Okay, so you guys are in Michigan. So I don't know the name of the department that covers licensing in Michigan, but when you get pass your exam and you go to apply for your mortgage, who do you apply to? State of Michigan. Who approves and issues your license? The Department of Mortgage and Finance in Michigan. Every state has this department. In California, it's the DFI. In Colorado, it's DORA, Department of Real Estate. It's together. Every state, it's called a little something different. But the main part of the state content, NMLS, you register and they track where you've worked. And they want to know if you change your address and if you change companies. And when you get you guys are being sponsored by your company. So and if you change companies, which you never will, no, anyways, you have to notify. There are all these rules about notifying the NMLS, but when it comes to licensing, who issues your license? State of Michigan. Who do you renew your license with? The NMLS tracks it and you have to report some stuff, but all of the stuff that comes with licensing and oversight, the NMLS makes sure every state has an agency that does it and that every state agency is doing their job. Make sense? So you get an NMLS unique identifier, you get a state of Michigan license, basically. So here's the processors. They don't need a license, but a little caveat is if a processor is an independent contractor, they need a license. So I have a contractor. She used to live here. She lives in Texas now. And all three of us at my shop, Jen processes for us. But Jen is not an employee. We pay her per deal. She's a subcontractor. So what does Jen have to do every year? Same thing we do. She has to renew her license because she's not an employee. So processors don't need a license unless, same with an underwriter. If you're a contract underwriter, which there are, you have to have a license. Otherwise, only the originator or people who do origination activities need to have a license. That's right. So she doesn't talk to my clients about their exact loan type or their rates. She still doesn't do loan origination activities. She could. And she does a loan or two herself when friends of hers and stuff, because she can. She has a license. She's a subcontractor processor, so she would need a license. Okay. So pre-licensing, you guys have our, background checks, credit report, and you have to renew every year and say nothing's changed and let them know what's going on in your world. So understand your 20-hour, your CE, 8 hours, 3, 2, and 2, 3, 3, 2, general. Oh, it's non-traditional. So the three, jot these down. So for the 20-hour class and the 8-hour CE, you need federal mortgage law, non-traditional mortgage, and ethics. That's so for CE every year, you need 3 hours of federal law, 2 hours of training for non-traditional mortgages, and 2 hours of training for ethics. And that's 7 hours. In Michigan, you may have a 1 hour Michigan class that makes 8. Right? So you have to have 8 hours. And a lot of states require a 1 hour or 2 hour or 3 hour. Most of them are 1 hour to make 8. Here in Colorado, they did away. We used to have a 2 hour Colorado class. They did away with it. So now we do CE. We have a 1 hour elective for people that don't have a state. So it's 8 hours, and it's general mortgage or federal mortgage law, non-traditional lending, and ethics, 3, 2, and 2. You have to take it every year. Also, what you want to know on the test, because this could be part of your test. If someone were to fail, I'm so sorry. If someone were to fail the exam, when can they retake it?
30 days.
All right. What happens if they fail it a second time? How long do they have to wait?
Another 30 days.
What happens if you fail it a third time?
6 months.
That's it. Right. All right. So those type of questions about testing definitely could be on the test. So understand your requirements for PE and CE and your requirements to keep your license in good standing. Right? You understand if you've had any felony in the last 7 years, correct? You can't get a license. But what about if I carjacked and committed manslaughter? Can I get a license? As long as my conviction was more than 7 years ago, right? What about if I was involved in money laundering or a scam to defraud? That's a never ever, right? So when it comes to background, 7 years for any felony, forever if that felony was at all financially related. Anything about fraud, money laundering, anything that would say, oh, this guy's scammed people out of money before or been involved in a financial scam, you're never going to be in the industry. All other felonies just have to be 7 years, okay? When they come to credit, what are they looking for? They're looking for fiscal responsibility. Basically, they don't care what your credit score is or that you've had some 30-day lates on your credit cards. But if you have massive collection accounts that aren't medical, if you have judgments and liens from stuff that you were supposed to pay that you didn't pay, if you've been in trouble or are currently in trouble for non-payment of child support, these are some of the financial situations that would not include you in the licensing for this year. You wouldn't be able to get a license. So it's not really a credit score situation when it comes to credit. It's really more about, do you accept and take care of your financial responsibilities that you're supposed to? Best way to understand that. So go through your UST stuff again, books and records and timing. Every state has different timings. So unless it's a federal law, don't worry about timing for 2 years or 3 years for this or that. Those are all over the place. So grounds for denying license, you can't pass the test, you can't pass the background, you've got felonies too recent or the wrong kind, or you're financially not doing what you're supposed to be doing presently. If you had some problems in the past, but if you have outstanding judgments and liens that haven't been paid or aren't being paid, those are some of the reasons why you would not get your license. Okay. So if you haven't noticed the NMLS, just you can Google NMLS test outline and you will find something very, like there's a bunch of them out there. They're very similar. Some of them have slightly different percentages, but these are very close to what percentage. So as you can see, ethics and UST, you don't want to blow it off, but it's also more reading. I go into depth more on the other activities. So when you guys go in Tuesday, understand, just take your ID with you. Just leave your phone. I mean, they'll give you like where I went, there's a small locker for your personal items, like your phone, but you can't take anything in there. You just show up with your ID, show up rested and ready. Let's talk about the test for a minute. You guys know anybody that's taken the test recently? Nope. You guys how's your, so what I find with test taking, and I've got over the years, people email me by the hundreds over the years as how they did or how they didn't do very well. But couple of things I want you to understand is some of the questions can be written to confuse you. So if you read a question once and you're like, blah, 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 what? Read it again. And in your mind, you're like, all right, what are they looking for here? Because they could ask a question about and give you all this information. And just because the information's in the test question doesn't mean it's necessary to figure out the answer. Right? So what are they asking me? What's the question? So you go find in all the paragraph, oh, their house payment is this, their debts are this, blah, blah, blah. Well, what am I looking for? So you want to figure out what the question is, then go back and extrapolate the information that you need. Because it can be, they try to make it confusing to make you understand. So just take your time. You've got like 3 hours for 115 questions. It's a lot of time. All right. So the first thing is if you don't get it right away, and I always say, make sure you read all the answers before you click B and continue. Just a simple example is how long you need to, when does the loan estimate due? 3 days after application. Oh, hey, 3 days. Well, C's 3 business days. So just make sure. And then if you're a little unsure, my number one thing I like to talk about when you take tests is make sure you eliminate 1 or 2 of the answers that it's not. In almost all cases, you may not know the right answer, but 1 of 2 of them aren't right. So just make sure you eliminate those. And then if you're just going to have to make I'm not really sure, instead of when in doubt, C out. Well, C could be a no way C's the right answer. All right. So improve your odds if you're not real sure by eliminating 1 or 2 that you really don't think it is. That's important for me for you guys to understand. And also know, one time I had a woman email me and tell me how she didn't pass. She got like a 72. Yet she didn't finish the test. I don't know. I had like 10 questions left because we had a chat. I'm like, well, when you go take it again, if you don't know or you spend too much time and you're not sure, you can flag that question. You click it and you move on. Because of those 10 questions, she only needed 3 or 4 right answers to pass. She would have passed, right? So if you're not sure, click it and move on, because it can be really frustrating when you get bogged down in a question and it's like, all right, I'm not really sure what this is. Click it and move on. And then when you get to the bottom, it will, the questions that you haven't answered, and before you submit, you have the chance to answer those. In 3 hours, I've only had like a couple people not finish the test. It's really a lot of time. So don't be in a hurry. Feel calm and confident and do your work before you get there. So understanding the test and how confusing it can be and asking yourself, what am I really looking for here? What am I looking for here? What are they asking me? And from that, you can eliminate some of the stuff that may not be needed. You can eliminate some of the answers as well. So most of the questions you're going to know right away. Some of the questions you're not going to be real sure on. So make sure you walk through that process. Okay. And then there's a lot of materials out there I'm sure you guys have for study. Spend a few hours a day. There's some ways, figure out where you think you need to get the most help in what section and focus on that section first. Because in general, I hear origination activities and laws. All right. Make sense? Scott.Genzer, G-E-N, you can see it on my screen, at ceshop.com. If you have any clarification questions or you want my input on anything between now and then, feel free to send me an email.
All right. Sounds good. Thank you, Scott.
All right.
Thank you, Scott. What was your email again?
It's my name. Do you see my name on my things? But
Yep.
with a period, Scott.Genzer at CE Shop, our company, ceshop.com. All right.
And hey guys, just a heads up, it's at gceshop.com. I'll drop it.
Oh, I'm sorry. Right.
No, you're good. I'll drop it in the chat too.
Yeah, thanks,
Yeah, if
Michael.
you can drop it in the chat, that'd be perfect.
Yeah, give me 1 second, guys, and before you take off, so I can drop that in the chat.
All right. All right. Well, I wish you two the best of luck. I usually start, Michael started today, but the mortgage business, I got into it as a really young man, and it's afforded me a life and some freedoms and some income that I never anticipated I would have, to be honest. It's an amazing industry. You're getting in at a tough time. I got in at 13.5%. It was a tough time, but you know what? You don't need a lot, and then you can build it from there. So I wish you guys best luck. If I can help you anyways, please reach out. All right.
Thank you guys so much, and I just dropped Scott's email in the chat for you as
All
well.
right, Michael, thanks.
Perfect. Thank you, Michael.
All right, guys. Thank you. Bye.
Bye.
Bye. Oh, I can get out of here. See you, Mike. Call me later if we need to.